for me, that was one of the exciting things, the challenge to be able to learn, and I'm never scared to put my hand up and say, I'm sorry, hang on, I don't understand what you're talking about here. Particularly in the early days at Chancerygate, when I'm in a meeting and we're talking about technical development stuff, or problems in the ground, or contamination, or drainage strategies. It was all new to me. But don't be scared to put your hand up and say, sorry, I'm not quite sure I understand that. Can you explain that to me? I strongly believe that long-term logistics and urban logistics will be a core, resilient asset class for investors. The fundamentals are undeniable in terms of the supply-demand dynamic, and clearly that varies slightly year to year. But if you look at the bigger picture, I'm very comfortable that the supply-demand issues that we have here are pretty identical across Europe. So it's really about making sure we've got the right local people in market. We want people on the ground speaking French and German, not trying to do it from the UK.
Welcome to the People Property Place podcast. Today we are joined by Richard Bains, Managing Director at Chancerygate. Chancerygate is a highly successful property developer, investor and asset manager specialising in the UK's urban logistics and industrial warehousing sectors. They offer a full range of in-house services to manage the development process in its entirety and asset managed funds. Richard has over 30 years experience in the UK property sector, and prior to joining Chancerygate was the head of the UK business at Rockspring, now Patrizia, and was specifically responsible for their UK-focused, closed-ended value-add funds. He's a graduate of Reading University and started his career at Cluttons before moving to Baring Houston and Saunders, as well as CIT after. And it gives me great pleasure that he's on the podcast today. So Richard, welcome.
Thank you very much, Matt. Thanks for the intro.
Not at all. Well, look, I've known you ever since I got into my role in recruitment way back in 2014. I think you were one of the early clients, as it were, that I met. So I've always had a keen interest in terms of how you've kind of navigated and what you've been doing over the last 10 years. But a place I'm sure you know where we always start these conversations is how and why you got into real estate. So if we can start there and then follow the story through.
Yeah, sure. So I guess like a lot of people, I had some family connections to the real estate industry. My father was a property lawyer for a relatively small company in a place called Worcester Park in Surrey. But he did a lot of work for a developer house builder called Gleeson. So he originally arranged some work experience for me working for a local estate agency, showing houses, helping with comps and taking calls and that sort of thing. And then school careers was, what are you going to do? And real estate was one of the opportunities. I think insurance might have been the other, fairly typical stuff. And I took a year off after school, and my father's connections helped me get a job working. So this would have been 1988 at the height of the madness of the market at that point in time, working in the city office of what was then Healy & Baker, doing office leasing and general dog's body stuff. But I had 6 months there, which was very good fun. And I guess cemented my view that this was probably the industry for me. And then by that point, I had a place at Reading University anyway, and off I went from there.
So did you want to go down the law route, or was it just more the surveying aspect that kind of suited you?
No, I don't think I ever had the patience or the sort of eye for the detail to go into the legal perspective. My sister did, actually. She was a property lawyer, but no, it was always the more tangible, what I saw as sort of people relationship bit that attracted me to the real estate industry.
So you did your degree at Reading a few years, and then you left and you joined Cluttons as a graduate?
Graduate recruitment program, yeah. So that would have been 92. So the market by then was a very different place, pretty challenging to get a job. And so I was lucky enough to get a place at Cluttons, working in Berkeley Square, 45 Berkeley Square, which was a great place to work. It was those days when all of the big firms were in and around Berkeley and Hanover Square. So, no mobile phones, no computers, different world, but really good fun, really good people there. And I did the graduate rotation. I started with, very hands-on granular property management, and then worked in the valuation team for about 2 years, which was a fantastic grounding. I spent the whole time on the road, there was no sat nav, so you'd find your map in the map drawer of the town you were going to and plan out your routes, and you'd be on the road for 2 or 3 days. We were valuing for people like Save and Prosper and TSB, very granular real estate across all sectors. And we do, road trips down to the southwest or up to the northeast or the northwest. So got to see a huge amount of real estate, which was fantastic for somebody at that age.
And did you enjoy the valuation aspect or not?
Yeah, I mean, it became a little bit repetitive when you're doing, those were in some cases monthly valuations. So they were sort of, traded entities which had to be valued on a regular basis. So there's not a lot of differential in between one month and the next. But so I think it was great grounding. Did I enjoy it? Did I want to be a valuer? No, not really. I always saw a way onto something else. But looking back on it now, what did it give me? It gave me huge exposure to different sectors and geographies. I mean, you come out of university and school and you look at these places, where's that on the map? I've got no clue. So you learn a huge amount about the real estate, the granularity of it, and just where everything is and how it all works, how it operates, what makes things tick. So it was great. It was good grounding, really good grounding.
And from there, you qualified?
Qualified there, stayed in that team for another 6 months or so, and then I moved into what was called their fund management team. But essentially, most of my time was working on the Crown Estate in St James's and Mayfair, helping Bob Clark, who was one of the senior partners there, who had the relationship with the Crown in sort of relatively complicated lease re-gears to facilitate development of things like Stirling Square, for example, just sort of to the side of the RAC Club down on Pall Mall, which was an old 1950s building, I think, and to redevelop, the developer who came in had to re-gear the Crown head lease. And so we were advising the Crown on what they could get. Could they increase their gearing, get a capital premium out of it, and then going through that whole process. So again, quite interesting and very different, but very focused on that St James's and Mayfair estate. And there are bits and pieces of other stuff, some smaller clients they had who had things all over the country, but that was the main focus of that work.
And you were with Cluttons for 6 years or so?
Yeah, be about right, yeah.
Did your role change there at Cluttons, or to kind of get a change, did you have to leave the business?
Had to leave, really, yeah. I saw it as being, I don't know how I made the decision, but I clearly made a decision that I wanted to go client side relatively quickly. And that I felt like the end of my progression was probably at that point in Clutton. So where could I go? Where could I learn something new? Where could I move forward? And I think I was just approached by a headhunter for the Baring Houston and Saunders role, which came along and was interesting. At that point, the history of Baring Houston and Saunders, if you don't know, they ended up being bought by ING and the legacy sort of business, I suppose, is now owned by CBRE Investment Managers. But at that time, it was an independent fund management house run by Rob Houston and Nick Cooper, who's now chairman of Fiera, I think. They ran a very successful fund management operation with some institutional clients like Rolls-Royce Pension Fund. We won the mandate when I was there for the Cadbury Schweppes Pension Fund. But actually, I originally went there to do corporate real estate. They had a small corporate real estate team who looked after Nokia's real estate in the UK when Nokia was a big company, or a bigger company than it is now. And we did quite a lot of stuff for the Barings banks in London. And we did a lot of work for Beale's Department Store, which was a sort of 20 unit regional department store company. So acting on the other side of the fence, good experience for a year or so. But being embedded in that business, I saw what was going on the other side of the fence on the fund management, the landlord side. And I think I realized relatively quickly that was where I wanted to go. And I managed to get myself an internal transfer, if you like, onto that side and ended up working on the Cadbury Schweppes pitch and then account, the Rolls-Royce account, Dorset County Council pension fund. It was those sort of separate accounts, which were probably between 100 and 300 million each, but across all, balanced portfolios, across sector, across geography. So again, a lot of travel. It was, there was an acquisitions team, but you would help with the acquisitions and sort of clearly help to buy into the positioning within the fund. Mixture of core plus, value add, opportunistic. So there was a little bit of development. I mean, one of the deals that I remember very fondly there was funding the development of the ground floor of the Royal Exchange in the city, which you probably know is now a really nice restaurant in the middle and lots of very upmarket boutiques around the side. Well, when we got involved with that, it was a metal box in the middle of that space, which used to be occupied and operated as the life trading floor. That was then stripped out, and we funded the development of that. I mean, that was a hugely complicated deal, sort of buying the land or the element of the land effectively, trying to agree pre-leases with all the very upmarket and particular retailers, the building contract, and so on and so forth. So that was a really fun scheme, and that was probably untypical of what we did, but it was one of the sort of more memorable deals, if you like.
And so was that? Did you kind of feel that was the place within real estate that you wanted to be in, and you'd kind of engineered yourself into that seat?
Yeah, I think. I mean, I had a great time there. A very, very interesting, good bunch of cohort people. If you look at some of the names of the people who came out of there, you know, there's some great talent, and it was very enjoyable, and it was a good next step career progression. It was very institutional what I was doing. There was no debt. You didn't really have to give any thought, or in what I did, that element of what I was doing, there was no debt. You didn't have to give a lot of thought to anything other than the sort of the equity and the balance of the portfolio in an institutional fund management type structure, effectively. So yeah, really good. Again, you know, good experience, good progression. I guess looking back, I had probably come to sort of the end of where I thought that role would take me, and again was approached and found a role at CIT, which at the time was very focused on Central London office, and they had put together a portfolio of large Central London office buildings, including places like Royal Mint Court, what was the Marco Polo building just south of Battersea Bridge, which is now residential. There was a big building up in Farringdon. There were 2 or 3 others.
High Street Ken, or just off High Street Ken?
Yeah, I think there was one there. Yeah. Stretching my memory a little bit here. And effectively, it was at that point in time, it was an arbitrage between the cost of debt and the yield that they could buy those assets at. So it was purely that, and it was lumping together high net worth individuals into structures whereby they could make things work. And so I was actually hired to be the asset manager for some of those office buildings. Within about 6 months of me being there, they sold them all. I was like, well, this is great. What's going to happen now? And I think looking back, I was sort of a bit, oh God, if I made the right decision, I should never have done this. But stuck with it. And I think there's a lesson there. You know, you quite often need to spend some time bedding yourself into a new job before you're really, whether you've made the right decision or not, whether you're happy. But it quickly, the opportunity within that company quickly sort of became apparent, and we were led by Martin Roberts, who now runs Addington Capital, and we were doing a lot of work with Morgan Stanley Real Estate Fund, which at the time was led by Matt Horgan, who subsequently moved to CIT, and so I worked with Matt for quite a long time, and got very much involved in the buying and the structuring of the next tranche of investments which CIT was involved with. Quite a lot of those were town centre shopping centres. We bought, I think, probably something like 15 to 20 of those in about a 2-year period in portfolios and singularly. But it was also the time just immediately prior to the GFC where, we were doing deals where we were putting 2% equity in, and you get 98% finance from RBS in terms of senior mezz and some sort of bridge equity. So, it was structuring to a new degree. It was debt, which I'd never been exposed to, and was suddenly thrown into, right, well, if you find a deal, you've got to go and find the debt for it as well, and then we'll package it all together and try and make it work. So suddenly you're talking to banks and negotiating loan documents, and so again, huge learning experience and doing something different, which I'd never done before. So really interesting in terms of structuring. Got involved a little bit with the equity sourcing, or talking to the equity, at least understanding that element of it, and also quite a lot of hands-on asset management. So it was real cradle to grave stuff, which I've always enjoyed in real estate, is the ability to, when do I get a buzz out of a real estate deal? It's not really when I buy it, it's when I sell it and I've made money out of it. That's to me the sort of the time to celebrate a deal. I think this was definitely the part of that, because it was all about making money and profit. It's not about an institutional fund where it's sort of a balanced portfolio and producing a certain return they want and outperforming a benchmark. Well, you can outperform a benchmark and have a pretty poor return. Here, it's about making bottom line money.
And you like the variety of the structuring, talking to equity, talking to debt,
absolutely,
looking at real estate and working out, should we buy that deal? And can we drive the right returns for it?
Yeah, and I think you quickly understand that a lot of the return out of real estate can be driven by the real estate fundamentals, but a lot of it is also about getting the structuring right and getting the debt terms right and making that element of it work. So that was, as I said, something I'd never had exposure to before. So was great experience and something I've taken with me since then.
Growing up, what kind of kids were you? Were you particularly academic? Were you? I know you're a big rugby player and fan as well. Where were your strengths kind of growing up, and where did you kind of excel?
I think I was academically sort of 3 Bs at A level, and back in the day when A levels were a bit harder than they are now, maybe. So I don't know what that translates as in today's language, but I wasn't exceptional, but I wasn't at the bottom of the class either. And again, I'd say in sporting terms, I was probably played my better rugby sort of post school, to be honest, and into university and after that. But nothing outstanding, but good social rugby and enjoyed the crack and always did. I played rugby till I was 33, 34, something like that. So it's always been a big part of my life. And back in these days, playing in the Surveyor Sevens for Cluttons and stuff, it was a big part of real estate as well. So that's always helped. So I think, I was, what sort of a child was I? That's a hell of a question. But yeah, I think sort of I've always got on with people. I've always liked sort of socializing and being with people and making connections. And, I wouldn't say my most natural environment is walking into a room full of people who I don't know, but there's always one or two friendly faces and then happy to chat and establish relationships and so on. So that, thinking about this before we stepped into the room, one of the things that I was thinking back to is, the contacts you make in all these different places you work and where they then go off and how that then feeds into your wider network. And before you know it, you've got a ready-made network in real estate, especially if you go somewhere like Reading or Oxford, or certainly back in my day, I'm not sure if it's as true now, the cohort of people who started in the same 1 or 2 years either side of each other in real estate became quite tight. Everyone socialized together, everyone knew each other pretty well. And again, that just expands your network even further. Not sure I've answered your question there, but anyway, on for the tangent.
No, you absolutely have, because it seems like certainly from the Cluttons, Baring Houston and Saunders to CRT, you've always seeked out that next opportunity. You've always taken the initiative, and you've always been very driven as well, right? And has that always been the case?
Yeah, I've always wanted to sort of to move forward and to continue learning, and that's something that's really important to me. Is whenever I move or whenever I'm doing anything, even today, people sometimes surprised to say, well, I'm sure we'll come on and talk about it, but when I took the Chancerygate job, I moved from an institutional environment to an industrial-led developer, and I wasn't a developer and I wasn't particularly an expert in industrial. But for me, that was one of the exciting things, the challenge to be able to learn, and I'm never scared to put my hand up and say, I'm sorry, hang on, I don't understand what you're talking about here. Particularly in the early days at Chancerygate, when I'm in a meeting and we're talking about technical development stuff, or problems in the ground, or contamination, or drainage strategies, it was all new to me. But don't be scared to put your hand up and say, sorry, I'm not quite sure I understand that. Can you explain that to me? And I think it's important that I do that now in my position, because it gives confidence to other people in the room to ask a question as well, when they're probably sitting there going, I've got no idea what they're talking about. So it's important to me that I'm in a place where I continue to sort of learn and have exposure to new challenges.
And so in terms of that financial engineering at CIT that you learned in that structuring, was that a relatively new phenomenon within real estate, or is it just because you changed environment, you're working in a more kind of private equity mentality?
I think, yeah. I mean, looking back at it now, I think it's definitely because it was just a different type of organisation. I'm sure it had been going on to some degree. I think I was probably slightly naive, not having had exposure to it prior to that, or being in a department or a role where I've had to have exposure to it. So it was new to me. Did I really know that was out there and there were people engineering when I was at BH&S? Well, maybe not. But I mean, clearly now it's become a much more important part of the real estate market, in which, the private equity firms and so on. I mean, there weren't nearly as many of them then as there are now. You didn't have the Blackstones of this world really back then to any degree. It was the Morgan Stanleys, the Goldman Sachses, those sorts of big sort of banks who've been around a little bit longer.
And in terms of the investable universe at that time, office, retail, industrial.
Correct.
But main food groups, retail and offices?
Yeah. Industrial was generally, if you've got a balanced institutional portfolio, it was probably 15% of your portfolio. And the rest was in office and retail, with probably a high proportion in retail. There'd be a 50% weighting to core and 30% to core plus, and maybe a little bit to value add. It was pretty vanilla.
And your role at CIT is transactions and asset management, as well as the structuring piece. How and when did you make the move, or the decision to move from CIT to Rockspring, and how did that come about?
So I was approached by Rockspring about a year or so before I left to go there, actually, because they were looking to hire a transactions guy into the UK team. And I think both they and I decided that it probably wasn't the right role for me. I wanted to be something more rounded and sort of more involved in as I said before, the cradle to grave, than just doing transactions. But I think we both kind of liked what we saw and said, look, I think the Rockspring guys this was sort of GFC had sort of hit, and they were planning this UK recovery fund, and they knew that at some point in time they were going to want a fund manager for that. So it was left that we'd sort of stay in touch and see what happened. And I don't know how long it was, maybe 6-8 months later, I got a call saying, would you come and have a conversation about that? And they had been pitching this idea to a number of their LPs, and so limited partners, i.e. the end investors, the sort of pension funds and insurance companies. But they didn't have a fund manager, and they got to the point where they had to find a fund manager before they could actually make the fund real. So I was recruited to go in there and run this fund on the basis that it was going to be more like a club than a fund at that point in time, because they had 3 cornerstone investors. And in between me taking the job and me arriving at Rockspring, for different reasons, none of which I'm told had anything to do with me arriving, they lost 2 of those cornerstone investors. So there was one there, but then my role changed from, right, you're going to have this money to invest and let's get on with it. It's a blind fund. You've got to go out and do this, to, well, you've got to get on the road and help us raise the capital first, which at the time was a bit frustrating. And actually looking back, we missed a great opportunity of a year of investing right at the nadir post GFC, where we could have picked up some great deals. But from my perspective, it meant that I was on the road fundraising, talking to LPs on a pretty much global basis, which again was something new to me. Never really had that experience, and in terms of the learning curve, was a big learning curve, was interesting, was quite fun, albeit, as anyone who's done it will know, fundraising gets pretty repetitive after a period of time. So I spent a lot of time in Scandinavia, in the UK, in Australia, small amounts of time in the US and Southeast Asia and the Middle East, trying to raise capital for this fund. I don't know how long it was after I arrived that we finally got a close off the ground and got going. It was probably 6 to 9 months. And then, it was invest the blind fund and get on an asset manager and put the debt structure in place. Do we have a fund debt structure? Do we do deal by deal? Do we do little portfolios of deals? Where are we going to buy? It was purely opportunistic. It was take advantage of a point in time when things were sort of distressed. Yeah. The mandate of the fund was to hit a 7% income return and a 10% plus IRR. So it was a bit of income. So it wasn't opportunistic. There needed to be a balance of income and sort of more interesting deals. So we put together a portfolio of some shopping centres. I mean, pretty much everything really. We did some office development. We did some student housing. We did some of the stuff in-house. We backed third-party operating platforms on some of the deals. So it was really good fun. I think over 18 months or so, we got it away. We raised about 350 million of equity. So we did about 550 of GDV, probably something like that. And then I was involved with sort of overseeing and some hands-on asset management as well. And then fully round tripping that fund and then raising the next one as well.
So were you having to reach out to investors cold yourself, or was there that support on infrastructure? They set up the meetings, but it was more about you kind of going, closing it, pitching the idea.
Yeah, so we had a fundraising team who put the sort of the meetings together. They would help with due diligence questionnaires. They would help with following up post meetings, and then closing deals with them, depending on whether the investor was big or small or was known to Rockspring. Was maybe done by the investor relations team, maybe done by the more senior people in the business, but it was a collaborative effort. So we did a lot. I did a lot of roadshows with the investor team, the investor relations team, and I worked particularly closely with a chap called Jose Pellicer, who was head of research at the time, who's now at M&G. Yep. We spent a lot of time on the road.
I can only imagine. Yeah. Again, it was pitching to institutions or endowment funds or pension funds, etc.
Yeah, so we raised money. Our big investors were Danish and Finnish pension funds. So like the State Pension Fund in Finland, Pension Denmark, and AP Pension in Denmark. In Finland, and those two are from Denmark. We raised a little bit of money from Australia. Had a couple of different investors down there. Some UK institutions through some of the consultants like Mercer were big supporters of ours. We actually, in the first fund, we raised a sidecar of high net worths who came through Barclays Wealth. So effectively Barclays Wealth were our investor, but then behind them were 50 individuals, private individuals, putting much smaller amounts of money into their sort of pool that came in. So they raised 50 million quid to put into the fund. And that was interesting because you go to pitch to them and they ask totally different questions to the questions that the institutional investors would ask. So kept you on your toes. And that's the thing about fundraising is, you can go and you come out and go, oh God, they're never going to invest. That went bloody terribly. And they're the ones who invest. And you think you've had the best. But to me, the most challenging and the most interesting and the most fun meetings were the ones where you got challenged and you got asked the difficult questions. You had to think on your feet. Otherwise, it's just hugely repetitive and you could just do it rote almost, which wasn't particularly challenging after a while.
So just going back, so leaving CIT to go to Rockspring, they had 3 cornerstone investors. They were looking to kind of close that off, but they needed you in situ in order to do that. It's that chicken and the egg, right? And so there's that risk in and around changing roles to go without anything being signed. Was there a lesson learned within that, or was it a case of you just kind of backed yourself to kind of go there, you backed the platform and actually... I
think it's more backing the platform. At the time, Rockspring was probably 50, 60 people. It was a pretty well-known, well-established name, and they had a number of different mandates. And I think, I'm not sure I really thought about it like this at the time, but looking back, I probably think if you're good enough and you get somewhere like that, even if this opportunity doesn't take off, they will find a place for you. So if you back yourself and you're confident enough in your ability and you go somewhere like that, then there's less risk than if you're going to a 3-man band or starting by yourself, clearly. But they were determined to make that happen, and we did. So all worked out okay.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People Property Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. And it was in and around 2014, where I guess you probably won't even remember, but we first, our paths first crossed when I used to recruit for what was called the FAT team back then. Yeah. Fund advisory and transactions, or fund acquisitions and transactions, or what have you. Essentially a made-up name for the analyst team, yeah. Yeah, who would be responsible for doing UK transactions and some wider and European as well. And European, yeah. It was a common analyst team, and we had some great people through there. And
I think you had Chris Webb on here, who was one of the members of that team at
Chris
one point.
Webb's been on, Bert Broadhead of Alterex.
Yeah.
And I haven't had them on, but Katie Robertson's obviously at KKR, and Yukin or YK's at Marway as head of transactions.
John O'Kell.
And Toby Creamer at CBI.
Toby Creamer, who I now do some business with as well. So the world.
To your point of
contacts, right? And it's up and down and wherever. But we had some really talented individuals who came through that team, and it was good fun. It was good fun recruiting for that team and managing them, hopefully helping them on their way a little bit.
So you were at Rockspring for just shy of 9 years or so. How did your role evolve there from this kind of coming through the door, getting involved with fundraising for the first fund? Was it just multiple different vintages following that?
There were 2 vintages of that UK Value Fund. The first fund, as I said, we invested in quite a lot of shopping centres. We managed to sell them in a big portfolio to Lone Star and did okay out of them. The second fund was more challenging, and it had some assets in it that I left just after we'd finished investing it. And I guess one of the reasons I was interested in moving on at that point, and that's probably the first time that I've proactively looked to move on from a role, was, Rockspring is now Patrizia. The sale process was in train when I was leaving. I knew we were going to be sold. It was clear we were going to be sold to a much bigger organisation, and I won't say who, but knowing some of the other names who were in the picture, they were all big global institutions, and I had no real interest. If you think about who I've worked for previously, they've all been relatively small companies. I had no real interest in moving to a big global behemoth. So I was proactively looking to move, really because of that. I knew that change of structure wasn't necessarily what I wanted longer term. But how did my role change? Yes, the day job was very much the UK Value Programme, but I took on responsibility for the wider UK team after a period of time. I don't know how long into my time there, maybe half, 2/3 of the way through my time. And that was looking after sort of, albeit Misha, who still looks after Hanover, which is the open-ended fund they managed, was in charge of that fund, but a little bit of help with that. We had quite a lot of UK assets in the Trans-European and the NPS separate account funds, so helping to look after those and advise. And also became involved a little bit in trying to leverage the relationships I had with the limited partners in my fund, who I built up quite strong relationships with, into other parts of the Rockspring business. So would they invest in other funds, or could we do some separate accounting stuff with them? So that was, I guess, how my role sort of morphed and changed. I guess probably became less hands-on as I went, because I had other responsibilities, and I probably missed that to a certain degree, but accepted that as you move up, then you have to give something somewhere. And that was the bit that I lost, I suppose.
You spoke earlier in our conversation about moving from a Rockspring to a quite a wide range of asset classes, instructions and LPs to a UK-focused logistics developer. Can you talk to me about how that came up? Because you obviously, Eddie Cook was in post before you.
Yeah, so Eddie had been MD at Chancerygate for, I think, 8 or 9 years. And I knew him from Rockspring days, really, when we had talked to Chancerygate about doing some business with them when I was at Rockspring, but had never done anything. He, I think, publicised his impending retirement with a bit of a Property Week article, and Eddie's retiring and he's standing down in a year. And at the time, I'd made that decision that I wanted to move on from Rockspring, so I just rang him up and said, "Look, I don't know what you're doing about your replacement, but I'd be quite interested in having a chat." And it went from there. So went and had a chat with Eddie, then met Andrew, who owns the business, and I don't know, however long later I was in place, and there was I think it was a 3 or 4 month handover with Eddie and I both in place, which was helpful, and then it was over to me. So it must have been reasonably interesting for some of the guys who were in place in Chancerygate, I guess. Who's this guy turning up who doesn't know anything about industrial or development? I say that relatively flippantly. I knew enough about both, but I was no expert in both, as I said earlier. But I guess what I brought, hopefully, to the company was the opportunity to add some of the skills I did have in terms of fundraising, being able to talk to investors, understand the whole piece of what makes real estate work, right? It's not just about finding a piece of land that could make a good industrial development. It's about buying it at the right price, putting the right debt in place, putting the right structure in place, finding the right equity partner for it, and so on and so forth. So I think that's hopefully what I've bought. And I think, Chancerygate, when I joined, was about, sort of high 20s people probably. And now we're 52, probably going to be 60 this year, I suspect. So you move from being still quite a small company to a medium-sized company where suddenly you're having to have in-house HR, in-house legal, and a whole raft of different operational structures, which, we're still evolving and going through at Chancerygate now. I'm sure we'll talk about it in a minute, but, as we look to expand into Europe, you've got to think about how can we manage all of this stuff centrally and make sure it's not just about people going and find the deals. You've got to have the backup and the support. So it was being able to bring that and that sort of infrastructure and I guess exposure or experience that I had of that previously, not necessarily hands-on, but knew a little bit more about how it worked and what needed to be put in place. So that's how it sort of started. And we've had as I said, we've expanded pretty significantly. The core is still very much the UK development function, and we're lucky to have Al King there, who's been development director, head of UK development for too many years, he's a great developer, and the team underneath him. We've opened regional offices in Birmingham and Bristol since I've joined, and that's really about being able to leverage those local relationships to do more in those jurisdictions. And that's probably one thing that sets us apart from most of our competitors in what we do, which is urban, small unit, multi-let industrial, is, we've got Warrington, we've got Birmingham, Bristol and London. So we are very local. There's nobody really who does what we do on a nationwide basis to the same degree. And that's what we're trying to replicate as we move out into Europe.
Can you just talk to me about the genesis of the business? Because Andrew Johnson set it up, right? Can you just, what was the kind of the story from set up through to, present?
So Andrew set the business up, I think it's 30 years next year ago. And he was essentially doing deals in West London, Park Royal, Southall, Hayes, that sort of area. And he was based there, knew everyone, knew everything that was going on. And it was real seat of the pants entrepreneurial stuff. So he would find a piece of land, and then he'd try and find a tenant and try and find a backer and find a contractor. And at one point he owned a contracting company, so he did contracting himself. And that's how it began. It was real sort of, seat of the pants. Let's find a way to throw all the balls in the air and hope that I can keep them juggling whilst I land the deal. And then as he sort of had more success, he grew it quite significantly to a point that pre-GFC he'd done. He had a company that was probably almost as big as it is now, and done deals with a number of institutional partners to back him. So grown up significantly. Ultimately sold half the business to Lehman just before they went pop. We had 2 years embroiled in that Lehman administration, which clearly was a very difficult time for everybody. We had done a lot of business with Lehman, so we had a lot of land, a lot of half-built schemes or built schemes with empty units, and so there was a long period of time when we were trying to just unravel ourselves from that. I say we, obviously I wasn't there at the time. But ultimately Andrew bought the business back from the administrators, and so now owns it himself again, and we built the business back from there. So I kind of look at Chancerygate's modern history, if you like, as the sort of post-GFC, post-Lehman administration rebuild of the business, where it's gone from a NAV of almost nothing and 7 or 8 people left in the company to where we are today.
And it's always been in multi-let, kind of smaller box.
That's
been
the USP, and we've done the odd single box, but I don't think we've ever built anything more than about a 70,000 square footer. And the typical Chancerygate scheme is probably 3 to 10 acres in a brownfield urban location, a variety of unit sizes, and we're good, I think, at eking out the best design for a site and but taking into account the constraints of that site, whether they be technical constraints or shape or levels. That's where we tend to win sites. If we're bidding on a big square rectangular that's totally flat, well, we're going to get outbid by a big box developer. We can't add as much value. But if it's something that's slightly quirky or slightly more challenging, that's when we tend to be good at making these things work.
Yeah.
And we do it in, all locations. So it's not just the core, yes, we've got we've got a fantastic site, probably the best site in Birmingham, which we're sort of going through planning on now, but equally we'll build in Norwich or, Pool, or so we will look more regionally as well. And because in a lot of those locations, no new industrial space has been built for 20-25 years. So if you deliver something new which ticks the ESG credentials and just provides a better environment for the occupiers there, the local occupiers still want that. And obviously one of the other USPs that Chancerygate still has to a degree, but maybe less so than in the past, is we're prepared to sell individual units to occupiers. So where we don't have institutional backers who clearly want to keep an estate intact and then either keep it long term or sell it as an investment, we're happy to sell freehold to owner occupiers. And there are a lot of businesses that want to own their own units, and they want to own nice new ESG, top credential units. But there's very few people who build for that end user. So if you want to own your own unit, you're normally buying something that's quite old and having to refurbish it, and that's still a bit of a compromise effectively. So we're selling some units up in Leicester at the moment, which are going really well to occupiers.
And who are the typical occupiers?
I mean that's the great thing about our sector is just the variety of tenants and occupiers who you have. I mean, Leicester's a good example, right? So it's very close to the hospital, and I think we've sold six out of 10 units up there. Some where we've leased them and then sold to investors, but others to occupiers. And 5 of the 6 units have gone to tenants or businesses that have some sort of medical background. So, there's a kidney dialysis operation in one of them. There's a manufacturer of medicine in one. I mean, maybe we should call it labs and put an extra couple £100 on the on the cost per square foot. So yeah, I mean, that's an example there, but yes, we still got the traditional manufacturer, storage and so on. We do more and more schemes where we have an element of sort of what I would call, I suppose, mixed use. So maybe some drive-throughs or some self-storage, something like that. Electric charging is becoming an interesting one now. We're getting approached on a lot of schemes, particularly prime schemes on good trunk roads for electric charging. And they sit alongside what we build as the sort of what I would call the meat and drink of a Chancerygate scheme really, really well. And obviously, not necessarily obviously, but probably 40% of our schemes have an element of trade units as well.
Yeah, I was going to say trade counter or retail driven.
Yeah.
Screw fixes.
Yeah, exactly.
Howdens, that kind of.
Yeah, and sometimes we build specific units because they have a slightly different design, the trade units to a normal industrial unit. So typically the trade occupiers don't want a mezzanine floor and they want a little bit more glazing on the front. So if or if you have confidence that there's demand from trade, then you would build an element designed specifically for them. But then quite often you won't. You'll just build standard units because you're not quite sure which tenant's going to come along, and you might still get a Screwfix or a Howdens or whoever who'll take a unit, and then they'll make it work for them. And
you'll sell them to the end occupiers. Is that because you're using balance sheet capital to develop those schemes, and then you'll exit, or is that even in schemes where you've got institutional partners that will back you as well?
It depends slightly. I mean, a lot of our backing is from quasi-private equity type institutions. So they are trying to hit a return and it's about maximizing the IRR. So for them, it's as quick as I can get in and out and as much money I can make in that period of time, I can maximize my IRR and my equity multiple. So for them, they don't really mind if they sell granularly to occupiers or if they lease and then sell the whole thing. In the past, in the more recent past, although not so much now, we exited a lot of schemes on forward sales or forward funding bases as well, which accelerates the return to our investor and to us because we know we're getting out of those at practical completion, regardless of whether we've leased the space or not.
Yeah.
More difficult to do that right now. I'm sure that market will come back in due course. some of the business we're doing, and you mentioned, I think earlier, the JV we have, CBREIM, their European Logistics Partnership, which is their European fund. I mean, that's built to core. So that is purely leasehold, and they are buying something because they want exposure to good quality, grade A, multi-let urban logistics. But it's very, very challenging to buy because the stock just doesn't really exist. And if it does exist, it's hugely competitively fought over. So their view is, well, let's build it, and then we'll benefit from that yield on cost arbitrage as well, the development yield, rather than just buying at the investment yield. So it's a little bit horses for courses, depending on who our partner is, and we have we've done business since I've been at Rockspring, Chancerygate, with Hines, with Northwood, CBRE now, and Bridges we've done a lot with. The
JR Capital.
JR slightly different. JR's on the investment side. So we also have an investment asset management team, and we raised some capital with JR Capital, which is effectively a conduit in London for family office and private money from the Middle East to come into the UK. So they have all sorts of strategies for their clients. One of their strategies is with us, which is a multi-let industrial investment fund. Well, two of them actually. And so that's about income return really for them. Income return with a little bit of capital growth. So that's buying up and let investments, trying to add value, benefiting and capturing reversion and pushing rental growth. So we've done 2 funds with them now, total of about £150 million. And that's the side of the business that we're really looking to develop now. It's always been, I guess, the sort of little baby brother at Chancerygate to the development side. We just brought in Simon Cowley, who's ex M7, and he's now heading up that business line. And we're sort of just beginning a big push to look for and try to sort of bring in a more powerful equity backer to really accelerate that side of the business, both in the UK and then over time, hopefully into Europe as well.
And is that just so you can have the recurring revenue, the fee stream there, which will complement the development highs and the lows and
exactly.
The upside?
I think that's one reason, definitely. I mean, that is, development undoubtedly is cyclical, and you can have a year where you make very little profit, and you can have another year where you make huge amounts of profit. And so that can be a little bit uncomfortable as somebody at the top of the business looking at revenue streams. So to have a more consistent income stream is one aspect of it. But the other aspect is we think it complements really nicely the development business, and that we should be able to leverage off the development business. Maybe we could offer the investment partner a little bit of development, which they like. It also means that if we've got someone like a CBRE who wants to keep something built to core, we can offer the ability to manage their asset going forward. So there is a lot of, I think, complementary business between the two sides. And my feeling and Andrew's feeling is that business line should be much stronger than it is. So that's why the push now.
Where do you see the opportunities in the market at the moment? Because there's lots of challenges out there, and they're well documented. But logistics, living, they're the kind of the darling Charles at the moment. Where do you see it in terms of the logistics market, where the opportunities are?
I think I strongly believe that long-term logistics and urban logistics will be a core, resilient asset class for investors. The fundamentals are undeniable in terms of the supply-demand dynamic, and clearly that varies slightly year to year. But if you look at the bigger picture, it's not easy to build the stuff we build. Planning's difficult, power's difficult, construction costs have gone up. So, it can put off a lot of counterparties. But the consequence of that is it means that there's very little new supply coming through. There's clearly a massive push for grade A in terms of the investor universe, rather than older stock. So again, if you can deliver it, I think the end appetite from investors is very much there. And becoming more so for the occupier as well. But that's perhaps less compelling when you're building smaller units than it is for the big corporates and the bigger units.
Because
I think some of them, they're not quite there yet. If you're a one-man band or you're mending cars, you don't really care, frankly. You just want to get on and do your business. Some of them do, don't get me wrong, and particularly some new businesses with sort of younger owner managers, they really care. But I think it's also, it's that transition. We haven't even talked about e-commerce, but it's that transition from the operator who used to have a shop, who now has a storage unit with perhaps some offices or some manufacturing in the office space above, or, I don't know, light assembly or something like that. They want actually a space where their customers and clients can come and it looks nice and it's presentable and it's not a grotty old industrial estate. And then on the supply side, we're fighting hugely still against the overriding demand for more housing and losing industrial land to housing. And that is being protected in certain areas. But, I don't think enough land is being allocated for industrial when we're talking about great swathes of space, whether it be greenbelt or brownbelt or whatever, being allocated for residential. We need to provide the infrastructure to supply those new households, and that's not being done. So I think those fundamentals are pretty compelling long term. Now, I've been in the industry long enough to know that you can't have a market that goes up and up and up and never comes down. So I think there will be wobbles, which is why I'm talking about the longer term compelling trend. There will be wobbles, undoubtedly. We've seen wobbles over the last couple of years, right? Our market's come crashing down and is coming back up slowly but surely. So I'm a firm believer in what we do. Where are the sort of the opportunities today? We see interesting opportunities in the UK on a granular basis. From day to day, I think we bought 6 sites over the past 6 months or so in the UK, in places like Manchester, Birmingham, Horsham. I'm forgetting 3, but there are 3 others. Newmarket and a couple of others. Milton Keynes. There's one I'm missing. These are opportunities for different sizes. Newmarket's 2.5 acres, Milton Keynes is 10 or 11. So different sizes, different size units, but the fundamentals of those individual deals we're really comfortable with.
And different challenges to overcome.
Yeah, of course. Yeah. From a planning perspective, from a construction perspective, from a power perspective. But we're also interested and spending a lot of time now looking at moving into Europe. So we bought a site in Dublin about 2 years ago, which has taken us slightly longer than we would have liked to get planning, but fingers crossed we're very close to that now, and then we'll be on site. We've just hired somebody in Dublin to be our man on the ground in Dublin. And we actually, on Friday last week, did our first deal on the continent. So we bought a site in Lisbon. And we will hopefully very shortly be closing on a deal in Spain as well. So we're focusing on Iberia to start with for various reasons. A lot of those Spanish cities like Valencia and Barcelona have very tight supply constraints, just geographically with mountains and sea and so on. So they're interesting markets. And we just hired somebody in Spain. We're looking to close a hire in Portugal right now as well. We're working in Portugal with a Belgian private equity company called Matisca Ream. So we've got agreed a JV with them there and working with them. They are present in the Portuguese market, but not in the logistics space. So it's our logistics experience with their experience on the ground. And then we're actually forming a joint opco with them. So that's quite exciting, quite new and slightly different structure to what we've worked with in the past, but works for both parties. So that's good. And our aspiration is to grow into 1 or 2 more jurisdictions over the next 12 months. And they will probably be the more core European markets. And I'm very comfortable that the supply demand issues that we have here are pretty identical across Europe. So it's really about making sure we've got the right local people in market. We want people on the ground speaking French and German. We're not trying to do it from the UK. That would be very challenging, especially when you're getting as granular as we do to buy the sort of things we do. And we're looking to replicate the Chancerygate model, albeit having or being sensitive to the peculiarities of those markets that we're in. So, we're not going to say, right, this is what we built in the UK, so that's exactly what we're going to build in Spain. We will look at what the market demands, and planning's different, so you can't just go and do that. Construction methods are different, so you can't just go and do that. But fundamentally, we want to be delivering grade A, good quality, well-designed, multi-let urban logistics units into those markets.
And then you'll build up those kind of local teams that will be responsible for deal sourcing, development, leasing, asset management,
Correct.
And everything else that goes with it as well.
Yeah. So all that done in country with some sort of central European function in the UK to coordinate equity, coordinate, I guess, process and governance effectively.
So you've been incredibly busy over the last few months with all these new initiatives that you've been driving. We touched in and around ESG within there. Is there anything else you wanted to kind of expand on when it comes to ESG? And I think I spent a lot of time talking to people about the environmental aspects. You've got to, you obviously have that as part of your consideration, but there's other aspects of the ESG agenda that you guys drive too.
Yeah, and we hired about 6 months ago Kathy Mayat, who joined as our first director of ESG. So she's firmly embedded in the company now and is looking to further that agenda across the E, the S, and the G. Because as you say, it's not just all about the E. I mean, the E is fairly fundamental to new developments and making sure that we're liaising and getting right with our partners, what they want to achieve. But from the S side, one of the big initiatives which Chancerygate it has been sponsoring, I guess, for the past 3 or 4 years is the Chancerygate Foundation, which is a foundation set up by Andrew and his wife to particularly focus on trying to help to bring Afro-Caribbean youths into the real estate industry. So, how do we address the diversity issue? It's very difficult to proactively at a senior level, force an issue if you haven't got the right candidates. So how can we bring them up from the bottom into the industry? So what we've done, what the foundation does, is it sponsors 3 or 4 students a year and gives them effectively a grant to help them through university in a real estate degree. So this is the first year that we've had. Well, it's our 3rd year, so we've effectively got a full cohort now. And so this will be our first summer when hopefully we'll be seeing some of them graduate. One of them's actually got a position on the graduate training scheme at Savills, which is fantastic. So it's really inspiring and rewarding to see those students coming through that process. And it's not just about financially supporting them, it's about giving them a mentor to help them as they come through the university process. It's helping them with work experience. That's not just at Chancerygate, that's with partners of ours who we can sort of expand our network and help to sort of provide placements in different places. Because some of them are QSs, some are, general practice surveyors, some are building surveyors. So it's not just, come and work for Chancerygate. So yeah, that's an important initiative of ours, which is very much driven by Andrew and his wife, as I say, and I think they've done a fantastic job with that.
Yeah, amazing, and it's great to get it in at the grassroots and see the seeds and the benefit of that for the years to come. Well, look, Richard, as we draw to a close, the question I ask everyone that comes on the podcast is: if I gave you £500 million of the capital, who are the people, what property, and which place would you deploy that capital?
So it's an interesting one, and clearly I knew you were going to ask this, and I've got 2 answers. I think one is probably pretty predictable in terms of what I've just said about the long-term sort of fundamentals of what we do. So I do think there is a place, if you're building a sort of longer-term portfolio, for potentially ground-up development. It might be buying existing assets in a sort of a diversified basis into the multi-let urban logistics market, probably across Europe. But I think actually switching it away and remembering that it's only for the past 5 or 6 years that I've been an industrial sort of specialist, if you like, I think there are some interesting opportunities. There's always an interesting opportunity when a market falls off a cliff and dies and everyone says, oh my God, that's never going to come back. And you look at what's happened with retail, even now you can see the signs of, if you buy the right thing, there's a nascent recovery coming through there. But I think some of the office stuff that's sort of just being discarded and sort of ignored at the moment is going to make some people a lot of money. So I think from an opportunistic perspective, in terms of how are you going to make money, in the next 2 or 3 years, if I was to look outside the industrial space, then that will be a space which I think is going to be an interesting one.
And are there any people that you've worked with or people that you admire or have had mentors that you bring along the journey?
Good question. I think if you're looking into that space, I've worked with some guys back in the Rockspring days who we backed, I worked with the guys at Morvale, XLB, Alchemy. They are all good, really good sort of asset management development companies who I think get the fundamentals of that space and will deliver good product.
Amazing. Well, look, Richard, you've had a phenomenal career background and you're right at the fore of driving the UK and European multi-let space. So thank you so much for sharing a little bit about your story, background, and excited to see what you and the team are going to do.
Thank you very much.
Thanks for listening to this week's episode of the People Property Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People Property Place podcast is powered by Rockspring. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockspring.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.